And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's the Thursday edition. That's right, second best day of the week. That also means that Michael Lebowitz joined us this morning talking a little bit about the Fed, what the Fed said yesterday. We're going to get into that this morning, of course. Was it the Fed, the last rate hike? Was it not? We'll talk about it. That's all coming up this morning with Michael Lebowitz. But earnings season right now continues to roll on this morning. Comcast reporting better than expected earnings and revenue. McDonald's beating EPS as well. McDonald's trading up about 2.5% this morning. So again, we're going to see kind of we have been seeing really over the last few days, the Dow really outperforming the S&P and the Nasdaq in particular. Tech stocks have been under a little bit of selling pressure, except for yesterday. Microsoft was down yesterday following their earnings. Google, nice day rally for Google after beating estimates and earnings and their outlook being good for Google. So again, kind of been an interesting market in terms of earnings so far. Companies that, when we take a look at the average or the normal kind of response to earnings that we normally have, companies really aren't being rewarded for beating earnings to a great degree. They're being rewarded, right? But we're not seeing big 20, 25% pops that we'd seen previously when companies beat earnings. But we're also not seeing stocks, brutally punished as much. And again, there's some outliers. RTX Technologies, had about a 10% down day following their earnings. But in a lot of cases, the impact to earnings, if a company misses, and the impact of their price hasn't been that great. So it's been a fairly muted earnings season so far. But we continue to kind of roll through this. Again, earnings season has been good so far. That's been providing a bid to stocks as well. That's been keeping, stocks moving higher here through the month. We're getting towards the end of earnings season, though. We've got this week and really next week. By the end of next week, we will have the bulk of the S&P will have reported. There's a few outliers, such as NVIDIA, which is always kind of the very tail end of earnings season. We won't even hear from them until August. So again, there's a few things that will come down the pike that will be important earnings-wise, but by next Friday, we'll have a big chunk of the actual major companies reporting earnings. And so we'll have a really good feel for just how good earnings were for this quarter. Now, one thing that is interesting is profit margins. Profit margins have actually now declined back to pre-pandemic levels. Now, where did profit margins come from? Well, that's obviously a couple of things. You have a boost in activity, right? People, buying a lot more stuff. And we had this big elevated surge in profit margins for companies because, well, we had $5 trillion worth of stimulus. You also had inflation, which allowed companies to increase their selling prices for the things that they were selling. At the same time as they were increasing their selling prices, they were reducing cost by doing things like, taking 5 Doritos out of a Doritos bag. It may not sound like a lot. Well, just 5 Doritos out of a Doritos bag. Multiply that by the, hundreds of thousands or millions of bags that you produce. It adds up. This is those, pennies make dollars very quickly for these companies. Just removing 5 sheets of paper towels from a paper towel roll, it adds up for these companies, and this is what we call shrinkflation, right? You're getting less money, you're getting less product, even though you're paying more money, and that was a big boost to a lot of these companies' profit margins over the last couple of years. Well, now that's fading, and we're now seeing those profit margins getting squeezed as inflationary pressures continue to come down, right? We're down to 3% inflation. That's going to weigh on profit margins. So one of the big questions that we've got to ask for going forward as we continue to look forward for earnings over the next couple of quarters and into next year, and particularly taking a look at profit margins, because ultimately that's going to affect earnings, is what happens if we continue to have disinflationary pressures in the economy. As inflation returns back to 2%, do margins continue to fall back to more normal historical levels of what a company can actually produce profit margin wise, right? That's going to be the big question. And so it's something to really kind of pay attention to those profit margins. We just recently wrote an article about how companies beat earnings and beat estimates, and that's on our website at realinvestmentadvice.com. It's an important read for you to understand how share buybacks and these accounting gimmicks are used to boost EPS. So when you're looking at the company that you're buying, are they really generating the earnings that you're paying for? And that's, while it may not matter in a really short-term period, days, weeks, months, doesn't matter, right? It's just the momentum of the stock. But long-term fundamentals matter, and they matter a lot. So you might want to read that article on the website, realinvestmentadvice.com. So here's what you need to know before the bell this morning. The Dow is on one of the longest winning streaks that we've seen in quite some time. And importantly, if you take a look at the Dow this year, really kind of year to date, a very different story relative to the S&P and the NASDAQ, which have been in a ripping bull market this year. The Dow really just now breaking out of a trading range that it's been in since the beginning of the year. The Dow really did not do a lot through the first part of this year, and that's that bifurcation of the market that we've been talking about. Just recently really broke out of that range and has had a very, very nice spike here. Now, importantly, the Dow is getting fairly overbought, but when we go back historically and look, we have to go back to a couple of months prior to 1987 to find a record win streak where the Dow was up every single day this long, right? So it's been a very long time, and so we have to go back again to 1987 to find a period of time where the Dow had this many consecutive winning days in a row. So I'm not saying the market's about to have Black Monday again anytime soon, but the point is that stocks can only go up every single day without having a correction eventually coming. And this is particularly important if you take a look at how overbought the Dow is right now. We have to go back a couple of years here to find, previous periods where the Dow was this overbought. Again, take a look at the RSI index as an example. You are at a level on the RSI index that has previously matched to peaks in the markets every single time. So again, when you go back historically, the Dow is extremely overbought here. We've had a very, very strong run. Not surprising because of, again, this kind of catch-up trade in the markets, trying to get, people wanting to get in the markets, buy these stocks. And that's now giving this Dow a lift here, which is great, right? So now we're playing a little bit of that sector rotation that Mike and I had both talked about earlier a couple of months ago. Now seeing that sector rotation really come into play. But the Dow is extremely overbought here in terms of how it's performing on a short-term basis. So again, as we kind of take a look at some of these, kind of previous periods where you've been, this overbought, it's one of those things just at least worth paying to and understanding that you're probably going to have a correction here of some sort over the course of the next couple of months, particularly as we move into the weaker summer months of August and September. But a correction back to the 200-day moving average, the 50, the 100-day moving average, certainly very likely here, particularly with the Dow, because it is getting extremely deviated. But it's the same story that we see with the S&P and the NASDAQ as well. These more extreme deviations from underlying moving averages certainly setting the market up here for a correction, at least of some sort, 3 to 5%, certainly very likely. That'll give you a much better opportunity to get into the stocks you're trying to get into rather than trying to chase them right here. I know I've been saying this for a while now, but again, these kind of manias in the markets, these what we call these buying stampedes, they tend to last for a while, longer than you would expect they would, but they always eventually correct. So be patient, you'll get a better opportunity, but that's what you need to know before the bell this morning. So when we come back from the break, we'll pick up with Michael Liebowitz. We'll talk about the Fed's last rate hike. Was it? And what do they expect about a recession? We'll talk about that coming up next right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So yesterday, of course, was kind of the big day, right? Everybody, we've all kind of been expecting, waiting for, this was the final Fed meeting and, for, rate hikes anyway. That's at least what's expected, is that this was the Fed's last rate hike. And, that's also kind of getting, brought into the markets here a little bit. But there were some very interesting kind of comments that came out yesterday in particular that we'll want to get into this morning. But let's start with just kind of what happened yesterday. Mike, what was your kind of initial takeaway from yesterday's meeting?
It was kind of a nothing burger. And first of all, thank you for explaining where my 5 Doritos went.
Yeah.
I've been wondering.
Hey, by the way, they took 3 Oreos out of a family pack of Oreos, too.
And that explains that, too.
Yeah.
Thank you. The market thought the Fed would raise rates 25. They raised it 25. The market's mixed on what the Fed's going to do next. It's about a 33 or 30% chance the Fed will hike rates at one of the upcoming meetings, not necessarily the next meeting. So, and they really didn't change their statement. They changed the verbiage and because they raised rates first, keeping them flat last time. But they really made very little change to what they put out after the meeting. So then you get the Jerome Powell press conference, and that's usually where markets will whip around. They'll go up a lot, they'll go down a lot, but you usually see a lot of movement from the stock market, and that's kind of, it's the voice of approval or disapproval as to what Powell's speaking and what he's thinking and saying and theorizing. And the market was flat yesterday. If you were watching a market when he was speaking, you wouldn't even know there was anything going on. He was just flatlining. At the tail end of his press conference, it dropped a little. The S&P fell 10, 15, 20 points, something like that. And it's because he said probably the most not controversial, the most enlightening thing of the day, which was basically that we don't see ourselves getting inflation back to 2% anywhere close or anywhere close to 2% until 2025. So, I think the market, you can see what the market's pricing in. The market thinks that the Fed's going to start cutting rates next year. The odds of a rate cut start becoming, we start having odds of a rate cut starting early next year. And by late next year, the market thinks the Fed will have done a few already. And what Powell's saying there is if we don't get inflation back to 2%, we're not going to get to 2%. And earlier he made numerous mentions that they're not going to cut rates until it gets to 2%. So, and then the other kind of interesting thing I thought he said is that they could continue QT while cutting rates. So the market isn't really getting a friendly Fed, right? I think the market knows the Fed is done or just about done. Maybe they go another 25, at the very most, maybe 50 more basis points. And the market's fine with that, it appears. What the market really wants to see is the Fed cutting rates and trying to nail the soft landing. There's a huge concern of these lag effects, that what they've done hasn't really been felt yet. And if and when they get felt, it's really going to pull down the economy. So every time they keep raising rates, they're adding more and more pressure to that, potentially to a recession. And that's the great unknown with these lags, is that the Fed is kind of driving in the dark. They don't know what they're doing here, because what they did yesterday may not affect the economy largely for 6, 9, 12 months, at which point some of those other rate hikes are really dragging on the economy. So I think the Fed's getting to the point where they have this debate between the hawks and the doves, and have they killed inflation enough versus are they forcing the economy into a recession, and trying to kind of find that in-between nice, comfortable spot where they keep inflation low and avoid a recession.
Yeah, and it's it's kind of an interesting point, because this morning the market futures right now up very strongly. The S&P is going to be up about 30 points this morning. The Nasdaq's going to be up about 185 points. Dow's going to be up about 50, 60 points or so at the open. So again, this kind of idea that they're kind of done hiking rates. It's also kind of feeding in now into some of the expectations. We're seeing kind of the terminal rate dropping here a bit. Interest rates on bonds themselves kind of fell yesterday as well. So, the market's trying to price in that the Fed's probably done, even though, and you're absolutely correct. They said that, Powell pushed back on this idea that the Fed might go to an ever other meeting type, analysis, but they said,
right.
No, we could raise rates in September, very likely, and we might not, but we might, depending on kind of what's going on. But they're kind of focused back on this data dependency and watching what the data is doing. And again, the data is fine, and we're probably going to start to see economic data improve here over the next month or so, and see some of these manufacturing indexes pick up. That's going to be a function of consumer sentiment, which had a big jump over the last week. We saw a big increase in consumer sentiment. Expectations for inflation falling sharply by consumers, expectations for better financial stability improving, expectations for higher stock prices coming, not surprising. But again, this all feeds back into that wealth effect that's created by higher stock prices, weighing back in on consumer sentiment. That's kind of a problem for the Fed ultimately, is because he's right, is that inflation isn't going to get to 2% anytime soon. In fact, we could see a pickup in inflation. Housing prices are back on the rise. If you take a look at some of the data for housing sales just over the last 2-3 months, prices of home sales are starting to go back up again. That's going to feed into homeowners equivalent rent. That's going to keep inflation elevated. And I think it could put the Fed into a really tough spot if we see inflation start to tick back up on a year-over-year basis. Yeah,
and what's interesting was I was wondering if probably not in a statement, but if Powell would mention the stock market and try to take some of the irrational exuberance out of it, like Greenspan did a long time ago. Mm-hmm. And he didn't mention the stock market, even though the Fed truly believes, and they've mentioned it. I think Bernanke originally came out with it in like 2003. That the stock market drives confidence, which drives consumption, which ultimately drives prices. So I wonder if they're actually like the stock market because it's boosting the economy. At the same time, what they're doing is creating a headwind to the economy. So they're trying to get this whole balance of, their policy tools, but also the way their policies affect confidence and markets and that sort of thing. So that may be part of their plan here, is to kind of let the stock markets rise, not get too out of hand, but let them rise so that they can administer the hard medicine or let the hard medicine they administered last year and early this year work and kind of offset each other and get your magnificent soft landing.
It's something we'll talk about here because I don't want to get into it just yet because we only have a couple of minutes left here before the break. But coming back from the break, I want to talk specifically about what Powell said yesterday in regards to a recession. In fact, that's kind of a interesting point because part of what he was talking about, the stately here. I'm just going to read to you from Bloomberg. The statement mildly upgraded the assessment of the economy, saying the activity has remained stable, but the Fed chief said inflation. The Fed officials welcomed the consumer price report showing that inflation rose by 3% in 12 months. However, the Fed is still focused on needing employment to come down, unemployment to go up, employment to come down, in order to really get inflation back under control. So, the one thing we haven't seen is any weakening in the employment market, really to any great degree. And that's been something that Powell has referred to several times as needing to get, employment to slow down, employment to weaken, so that consumers will spend less money and help bring that inflation rate down. But we haven't seen that just yet.
Right. And again, with the stock market, if consumers are going to spend more, companies need to hire more. So, so I guess the question is, can inflation really get to 2%? And let's just say it gets stuck between 2.5 and 3.5. Mm-hmm. Is that good enough? Now, Powell has told us pretty bluntly that 2% is their goal and they're not stopping till they get to 2%. But my guess is 2.5 to 3% inflation they would love that because it does on the margin reduce the debt, right, as a percentage GDP. And but I just think they're not going to say it until they're very confident that inflation is kind of taken care of. All those factors that drove inflation have abated. Right.
And again, we're going to see that. And again, when we take a look at, consumer confidence, again, that's improving rather sharply here. If we start to see some of the economic data begin to actually improve, like the manufacturing indexes, those type of things, if we start to see turns up in that data, suggesting that, the economy is starting to grow or to expand, then that's going to lead to more hiring, which again is going to kind of put the Fed in a tough spot of trying to get wage pressures down, trying to get inflation to come down. That's all going to kind of feed back in. And this is going to be something that, we'll be, obviously looking at and talking about as we go forward. But, this whole idea that the Fed has beat inflation at this point is, too early to tell. Back in the 70s, we saw a very similar situation. Inflation was coming down, looked like they'd gotten it back under control, and then it went off running to the moon when we had the oil embargo. So, that's the one thing we talked about before. That's kind of Powell's biggest fear is this resurgence of inflation. Just as soon as you think you got the inflation monster beaten, it comes roaring back for another round. And, that's a big concern because again, at that point, you've got no choice but to start hiking rates pretty aggressively again. But we'll come back after the break. I do want to get into this. A very interesting comment that Powell did make about a recession. And, this has been the big debate. Where's the recession? We've been talking about a recession now for 2 years and still no recession. And this lag effect, where is it? We'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I'm not very good at accepting help, particularly when I don't think I need it. And that's a very true statement. I don't need help. If I can't figure it out, I just don't do it.
The Real Investment Show podcast. Same show, your schedule.
It's a personal challenge. Of course, my wife has been saying that for years. Every time she looks at me, she goes, shakes her head. She says, you need help.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So Powell made an interesting comment yesterday, I thought, during his press conference. He says, it's a good thing headline inflation has gone down a bit. Of course, you know, we're talking about headline inflation going from 9% to 3% in the latest reading. He said, quote, I would say that having headline inflation move down that much will strengthen the broad sense that the public has that inflation is coming down. Here's the interesting part. So I agree with that, right? So inflation's gone from 9 to 3. Everybody's like, inflation's over. I feel a lot better. Here was the interesting part of that statement, which will in turn, we hope, help inflation continue to move down. I don't understand that part of the statement, Mike, because here's the problem with that statement. If inflation has gone from 9 to 3 and consumers go, whew, inflation's over, thank goodness, my 401k plan is higher, my stock portfolio is higher this year, I'm going to go out and spend some money, right? Things are costing less. I've got more money in the bank. I feel better about things. Consumer sentiment shows that consumers are feeling a lot better. The job market's just fine. No real fear about losing my job. Why would I not go out and spend more money? So it's kind of an interesting conundrum of what Powell said about inflation coming down is that he hopes that'll give consumers a sense it is coming down and that'll help inflation move down more. It's actually the opposite. It's going to make people go spend more money, which creates demand, which increases inflation, right?
Right. Well, the Fed has long believed that inflation expectations are probably the most important factor guiding inflation. So I feel like he's taking a rule from the pre-2020 pandemic,
Yeah.
when inflation was relatively flat. He made another comment that I'm going to have to do some work on, but he said core inflation leads headline inflation. So core inflation is just they basically take out food and gas. And the reason they do it is because they're volatile, they go up and down. And if you kind of strip those out, you get a better reading of inflation, even though we spend 2/3 of our money on food and gas. Or not, maybe not that much. But so what's interesting is I think that, core inflation is a better gauge of inflation when inflation is relatively flat, between 1% and 2.5%, where it was for the last decade plus. But in a trending inflation environment, which we've been in, and we haven't been in one for a long time, I'm not so sure that's the case. I just think that core, for many reasons, is slower to rise and slower to increase. So I think he's actually got it wrong that headline inflation is leading core. Headline inflation was the first to go up, when we saw used car prices spiking and oil spiking and other goods that aren't that big in the calculation, but they were spiking in price. Headline inflation went up and then core followed. Headline came down as those prices normalized, or even, we got some prices falling in some of those sectors. And now core is starting to follow. And the thing I really don't, I've read a lot on it, and I still don't have a great feel for it, is housing and shelter. Shelter's a third of the inflation number. Mm-hmm. And we know that Lance mentioned about 5 minutes ago that house prices are starting to pick up. Mm-hmm. Well, they're starting to pick up in real time. They're not starting to pick up in the Fed's numbers. That won't happen for a long time.
Yeah, 3 months.
More than that, actually, because you think about it like this. Their number is imputed rent. And rent prices are a big part of the number. So every month, in theory, 1/12 of people that are in an apartment see their rent change, mm-hmm. right? The landlord says, okay, you've been here for another year, we're increasing your rent. And it's probably less than 1/12 because people have longer term leases as well. So, the Fed is looking at that, and if rent prices go up 10%, but it's only happening on 1/12, you're not getting that big of a rise in rent. Whereas the Cleveland Fed has told us, actually, we put this in our commentary a couple days ago, they have another rent index that looks at just those rents that are due, that have just recently reset. And that gives you a great idea of what's happening with rent. And that's been plummeting. And that's the same evidence we're getting from other companies that are involved in a rental business, and Zillow and a few more. So what I don't understand is I think shelter prices are going to come down still a lot more in the CPI number. That doesn't mean they're coming down in the real world,
right? But
in the CPI number, they're going to come down sharply, and that's a third of the number. So, the Fed is making no mention of that, and a lot of economists don't really mention that, but I think that could be a big deal, and it allows CPI to come in below expectations here for at least 3 or 4 more months.
Mm-hmm. Yeah, no doubt. I mean, this is going to be one of the interesting things. Again, this is why people always have such a distrust of the CPI numbers. Like, oh, they say inflation's this, but X is costing me this or Y is costing me that. That's why the average consumer doesn't trust inflation, right?
Right. Well, first of all, it's impossible to calculate inflation.
Yeah.
Right. You live in a different state than me. You spend your money on different things. How do you have one basket of goods and one price for that basket of goods for everyone? Right. We're all very different in what we spend and how and when we spend it and all that. So first of all, we got to get rid of this notion that there is a CPI number, because it's different for all of us. And then we also have to get rid of the concern that it's 3.1 versus 2.9, right? The variation doesn't matter. I think what really matters is the trend. Is it going up? Is it going down? Is it just flatlining?
Yeah.
And it's been flatlining prior to the pandemic, flatlining, right? Going up a little, going down a little. Oil prices jiggle. This goes up, that goes down. But in a trending inflation environment, I think it becomes a much more important data point to follow and to to care about. But again, whether it beat or missed by 1/10 or 0.2%, I think is ridiculous. What matters is the trend, and that trend has been falling for a while now.
So,
and
yeah, go ahead. No.
I was just going to say, and it will, and we know it will because of the way the Fed calculates their numbers. Their data tends to lag. And the lagging data is fine when CPI is kind of flat. But in an environment like this, you really want that real-time data to know what inflation's doing.
Yeah. And this kind of feeds back into, the Fed's comment on recession. And again, you've been talking a lot about the lag effect. We've written about the lag effect. When's the recession showing up? And there's, and yet it hasn't shown up yet. The economy's still clicking off at 2% growth. Employment still remains, very close, very full employment levels. And I thought Powell's comment yesterday about a recession was interesting. The statement mildly upgraded the assessment of the economy to say activity has been expanding at a moderate pace. The Fed compared to June's modest pace, so he actually upgraded the rating of the economy. But during the press conference, Powell shared that the Fed staff is no longer having a recession in their projections, which are independent of those issued by policymakers. So the staff of the Fed is now basically marked out a recession, saying, we're not going to have a recession. We're going to have, we're having the slowdown economically. That kind of aligns with what Goldman Sachs has now been saying here for the last, probably 2 quarters, is that the economy will get close to 0% growth potentially in the next quarter, but then start to reaccelerate into the end of the year and then into next year, which also kind of corresponds with this big surge in earnings that people are expecting next year for the S&P 500 as earnings return back to $220 a share or potentially even higher. You have to have stronger economic growth for that. So it's a real conundrum between the bears that are expecting a recession and the data continues to suggest that no recession is coming. So what was your take on that?
Well, first of all, Lance, can you remind me when the last time the Fed did predict a recession accurately?
No, they never have.
Right.
Neither has anybody else, by the way.
Right. This is, and the problem is, look, the economics is like the weather. It's dynamic. It's always changing. There's all these factors that are somewhat unpredictable and change the outcome. So no one can predict it. We certainly have ideas, and we know like this, and this is where the lag effect comes in. We know there's an incredibly strong headwind that's brewing, that's coming, that's already hitting the economy to some degree, but it's only going to increase in size. We know that. The question is, how does it affect the market, and can things like improving confidence help overcome those headwinds? So, I feel like we're weather forecasters to a degree. We know certain things are going to happen, right? We know there's a cold front coming in. That cold front is the very heavy, the very strong headwinds. But what we don't know is if the clouds will materialize and give us the recession. And, no one knows this. And the Fed's guessing, economists are guessing, we're guessing, we're using the best, the facts that we know. But things change over time, and we all adjust to them. But that headwind is still there, and it's only growing stronger. And it kind of hit home for me yesterday that the Fed raised rates. They're now the highest they've been since 2000. I think it's 2001. Mm-hmm. The total debt outstanding in the system is 3 times what it was in 2001. So we're dealing with actually slightly higher interest rates than they were 22 years ago, but 3 times as much debt. So to think that what the Fed has done will not affect the economy, I think is naive. But right now, it looks like everything, like the economy can withstand it. But I still have a hard time believing that, given how indebted the economy is, that it will be able to avoid a recession.
Quick break. We'll come back and we'll wrap up the show. Talk a little bit about some of the earnings that came out yesterday, this morning. Like I said, markets pointing sharply higher. So we'll talk a little bit about the markets, where to next for the markets when we come back from the break with Michael Leibowitz.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So yesterday on the show, I was talking a little bit about earnings as we go through here, and there's some companies to kind of pay attention to if you want to really kind of know about what's happening with the consumer. One of those was Chipotle Mexican Group, which is, as we've always often said here, it's the world's most expensive burrito if you take a look at valuations. It's a restaurant, fast food restaurant, casual dining, very popular. And, here's a company that, when you take a look at Chipotle Mexican Group, again, they're a fast food restaurant. They trade at basically 6 times price to sales. Valuations are high. They trade at a 51 PE. So it's a restaurant. And, this has been one of the favorites of, hedge funds and portfolio managers, et cetera. So in that fast food space, Chipotle Mexican Group has been one of the clear winners across time. But it's also a good indication of what's happening with the average kind of retail person. This is kind of that mid-level casual dining fast food restaurant. It's not cheap to go to a Chipotle, by the way. So you're gonna drop some money if you go to Chipotle. But for the average American, it kind of fits right in that bill. So if you kind of want to know what's happening with the consumer, Chipotle Mexican Group is one of those stocks you kind of take a look at. And it was interesting in their earnings yesterday. They did beat estimates yesterday, and what was they said? So so they said that their second quarter earnings, they beat expectations. Revenue was $2.51 billion, which was short of estimates. So their revenue wasn't high as is expected. They also expected only growing at 7.4% in the quarter, and analysts expected 7.5%. So again, this is kind of one of those, as Mike was talking about, this lag effect of the economy, what's going on, is there going to be a recession? There are certain companies you kind of look at and say, okay, here's a kind of a thermometer of what's happening, for the kind of the average American and what's going on. And I always like to look at Chipotle Mexican Group as one of those. McDonald's is another one. That's, a lot of people eat at McDonald's. The problem with this is you have to look at McDonald's earnings. They always report adjusted earnings. So you've got to go back in and kind of refabricate what their actual earnings were. But, those are things that you want to look at. Are they growing revenues at a level that suggests the consumer is doing just fine? And so far that's the case. They're a little bit weaker than what people were expecting. Chipotle Mexican Group is going to be down about 9% at the open this morning. But again, those are the kind of things that you want to kind of pay attention to. There's trucking companies, and we talked about industrials performing very well here lately. Transportation stocks are doing well. Those are all suggesting that the economy is kind of firing on all cylinders. And for right now, that's just kind of the case. And there's certainly, as Mike was making the argument for a minute ago, it's hard. When you take a look at leading economic indicators, you take a look at inverted yield curves. There's certainly all these warning signs that a recession's coming. Yet, everything else seems to be doing okay. And that, Mike, this is the hard part of managing money, is trying to, have these expectations of what might happen, try to hedge that risk, but then also be aware of what's happening in the markets right now. And that makes it very challenging for investors.
Right. And that's, I think, where, you have to put everything together. It's not just kind of macroeconomics. It's fundamental, it's valuations, and it's technical analysis. And technical analysis, at the end of the day, is really, it's not voodoo. You're just really gauging the behavior of investors. And, you can look at trend lines and indicators and calculations, and it helps put together a good sense of what investors are thinking and what they're doing. And it allows you to trade to be long in an environment where your macroeconomics says to be short, or to be short in an environment where the macroeconomics are positive or good. And, that's the hard part of managing money. It's separating out your long-term opinions from what's going on in the ground in a very short run. And I feel like we're in one of those instances now, because I do feel there will be a recession, albeit it may not be for another 6 months. But it doesn't matter if there's a recession, because our job is to manage money. And if the market's going to keep going up, we're going to be on that train, knowing full well that there are risks to being on that train, and knowing where we can get off the train if need be, what levels make sense that we start exiting the trade. But, right now, this market is very bullish. Like you said, the Dow just set a 14 game winning streak?
Yep.
Since 1987. It's interesting, it's 1987, and I'm not saying there's a 1987 event coming, but I think what that goes to show you is that sentiment can be extremely bullish, and at the same time, you could have a pretty big decline shortly thereafter. Not immediately, but thereafter. And you go back and look at 1929, and you go back and look at other peaks. When you get to these peaks in markets, sentiment is really strong, not surprisingly. So you can look at sentiment, and you can see when was that sentiment turning. And when do the macroeconomics turn? It's very possible we could get a little bearish on the market, but the macroeconomic view gets a little better. So, it's just a lot of juggling we have to do, Lance.
No, it is. And again, a lot of this stuff, when you talk about lag effects, we've never had historically, $5 trillion worth of stimulus that, boosted M2 money supply to the level that we saw, and then having to work that supply out of the markets. And, historically, we haven't had that ever to deal with in terms of how that impacts the economy. At what point does that economic slowdown occur, as that money does exit the economy, or so to speak, or gets absorbed by the economy? And that's taking a lot longer than anybody imagines. So, there's a real possibility. I think you're wrong about a recession, Mike, in 6 months. I think we'll have a recession, but it's not going to be till 2025 because of that massive impulse of liquidity in the markets. It's just going to take a long time to work that out of the system. And again, and it's not just that stimulus. You still have the $1.7 trillion of Inflation Reduction Act. You still don't have the student loan payments back on yet. So there's a lot of things that are still sitting there supporting the economy that's pushing that lag effect of the recession out. But in a good way, if you are expecting a recession, the fact that fewer and fewer people now expect a recession actually gives you the ability to have a recession. As we said last year, everybody thought we were going to have a recession last year. And we said, can't have a recession. If we do, it'll be the most forecasted recession ever in history. Mike's right. Nobody's ever forecasted a recession. The fact the Fed is no longer forecasting a recession just actually sets us up now in the next 18 months or so to actually have a recession. But because of all this lag effect of money, it's just going to take a lot longer to get there. And so, so now we're getting into that phase of the markets where people are now, removing the risk management from their portfolio. They're now piling back in. They're creating, back into a bubble in stocks, so to speak, particularly on sentiment. If you take a look at investor sentiment, it's pegged right now. We're just as bullish as we can be. That sets you up for a bigger correction in the markets at some point. Not a bear market. I'm not talking about a 50% decline, just a bigger correction than probably what investors are expecting.
And here, going back to kind of how you started this, I think what's interesting is I'm more on the economy. I think a little more bearish than you. At least I think we get a recession before you think we get a recession,
right?
And maybe even a year before you think, right?
Yeah.
But on the money management side, we've been in agreement.
Yeah.
We go through phases where we're not in agreement, and we find middle ground and we work around it. But we've been very much in agreement for the last couple months. Mm-hmm. And it just goes to show you got to separate out those macroeconomic opinions, geopolitical opinions, whatever's going on in the world with what's going on in the market.
Right. No, it's true. And it's just, and again, we don't know, you don't know, and I don't know. And this is the challenge, right? Is how long this monetary bubble that we created, from MMT. Right. And so, by the way, it's just, we were writing a bunch of articles about MMT and the fallacy of MMT, when Stephanie Kelton was running around and having her 15 minutes of fame, the fallacies of MMT. And we tried it, and now you know what the results are. and so,
right. Where's Stephanie, by the way? I haven't heard from her in ages.
Yeah, she's that quickly disappeared when everybody figured out that MMT doesn't work. And
the other guy, the other person that was pushing it was the guy from Long Term Capital. Yeah. I'm drawing a blank on his name.
Randall Ray.
Yeah, no, not him.
Him. He was too.
It was.
It was the guy from. I know who you're talking about. I can't think of his name.
And we know how Long Term Capital worked out. His theories.
Well, the thing is that the idea, it sounds great, but at the end of the day, somebody's got to pay the tab, and that's what comes around, and you pay that through inflation. That's eventually what's going to occur, and it has occurred. And now we know, okay, we don't like that, so we'll see. It's going to be interesting. The one thing that the market still has completely discounted is QT, and the Fed is restricting liquidity to the markets. That hasn't changed. The markets are discounting that drop in liquidity. We'll see how long that detachment from liquidity can remain, but that's all part of this function of this kind of monetary surplus is still sitting there in the markets. And at some point, this is all going to have to equate back to each other. It's simple math. And at some point, it's all going to have to balance. The question is, and to our disagreement of timing, it's just a function of timing. It may not be 6 months. It might not be a year and a half. It might be 10 months, right? It may be somewhere in the middle. But, that's going to take time for that to balance out. You got 10 seconds for the final word.
There's no such thing as a free lunch.
There you go. All right, that wraps up the show for today. Get by the website, realinvestmentadvice.com. Michael Lewitz's latest article is out on the website now. So simply go by realinvestmentadvice.com. Get that. Check out our latest newsletter as well. I'll have the new one out this weekend. And, of course, as always, make sure you subscribe to our daily market commentary, our videos, etc. We appreciate you all. If you have any questions, simply just ask a question right there at the website. Comes right to my desk. I answer every email every day. realinvestmentadvice.com. See you back here tomorrow.